Good afternoon. Welcome and thank you everyone for taking the time out of your day to join us. The topic of today's webinar is diversification and liquid alternatives in 2016 and beyond. My name is Andrew Beer and I'm the managing member of Beachhead Capital. As many of you know, we've studied extensively the evolution of the liquid alternative space over the past several years and thought that a webinar might be useful to a broader investment audience. We're going to cover a lot of ground today, so we may move through some of those topics quickly. Just as a reminder, the call today will be in listen-only mode. If you'd like to submit questions, there should be a box in the panel on the side of your screen, and we'll try to save the last 15 minutes or so for Q&A. Please note that if you have any follow-up questions, we are more than happy to address them offline. So here's today's agenda. The webinar will be broken down into 4 sections. I'll very briefly, I promise, tell you who we are. Then we'll cover the theory and practice of diversification. The third section, and probably the most important, is on case studies in the liquid alternative space. And finally, we'll leave you with a few takeaways. So in order to understand where liquid alternatives fit in diversification, it's really important to break down the rationale for diversification in the first place. So please bear with us as we walk through the key points. Just a quick reminder of who we are. Beachhead Capital is a hedge fund advisory firm based in New York City with over $500 million in assets under management. We are registered with the SEC and CFTC, and please note that for this reason we will not be discussing Beachhead products today. This is purely about research. At Beachhead, we have 2 core businesses. We allocate capital to hedge funds, and we manage a liquid alternative strategy, dynamic beta, that seeks to match or outperform leading hedge funds with low fees, daily liquidity, and transparency. Our dynamic beta business is GIPS compliant, and we are fortunate to serve as the sub-advisor on both a mutual fund and UCITS fund for SCI investments. For purposes of this call, we've published extensively on the evolution of the liquid alternative space, the hedge fund industry, and related topics. For our institutional research, please take a look at www.beachheadcapital.com, and for our blog, market research, and educational videos, please see www.dynamicbeta.com. Now, without further ado, let's jump into it. The investor narrative and diversification. We need to start with how investors view the world and where diversification fits into this. While each investor has a given area of expertise, the world is simply too complex to be an expert in everything. Consequently, investors concentrate their time and energy in that area and seek to build a competitive advantage in information and processing. In addition, all investors have a narrative about the state of the rest of the world. You can think of the investor narrative as the background fabric underlying each investment decision. In order to make sense of a complex world, we all make simplifying assumptions. For instance, we assume that low probability events won't occur. Yes, there is some probability, say, that a full-scale war breaks out tomorrow, but for purposes of day-to-day decision-making, we assume it won't. We call this rounding down to zero. It's simply impossible to get through the day when you're staring at the sky looking for comets. By extension, investors also tend to assume that other areas of the markets are priced reasonably efficiently. By this I mean that when plugging in, say, GDP assumptions for India into a model, I'm likely to assume that the India experts have it right. So we have an interesting paradox. As professional investors, we assume that our subset of the market is not efficient, but the rest of it is. You'll often hear the term, the market ascribes a high or, say, low probability to a given event. The investor narrative is important in understanding market drawdowns and how investors react. And this all comes back to why we diversify in the first place. Sudden market drawdowns occur when the narrative is shaken. For example, when a big risk jumps from the background to the foreground. To matter, the risk itself must be big and outside the typical investor's wheelhouse. Often these risks are difficult to price. That is, we know the probability just went up a lot, but we're not sure by how much. Think of Brexit, the invasion of Ukraine, Ebola, a potential renminbi devaluation, dollar-denominated debt, oil, and you get the idea. Speaking of which, the world today, risks abound. If you feel like the world is a precarious place today, you're not alone. Here's a map with a partial list of potential market-moving issues from around the world. Just glancing at it, it's easy to envision a new risk popping into the headlines and throwing investors off their game. What if a China devaluation sparks another currency war? Or Brexit further calls into question the viability of the euro? Or we get widespread defaults in commodity exporting nations? Any of these could spark a material drawdown in the equity markets. What's striking, I think, when you look at the map, is how many potential risks there are. It's like there are a ton of comets in the sky. So where does diversification fit into this? The two benefits of diversification. Diversification often is taught in abstract statistical terms. We've all seen how an optimized portfolio will have an efficient frontier, the point where returns are maximized for a given level of risk. We show one of those charts on the lower left. As we add more potential investments, the efficient frontier moves to the upper left. That is, we get more return bang for the same level of risk buck. This is unquestionably good. But this framework has little practical value when the narrative is shaken and investors panic. A 20% drawdown feels much worse than being told that it's a normal statistical variation given a stated risk tolerance. And here's where diversification has important behavioral benefits. Clients or end investors can derive a disproportionate level of comfort from having one or more winners in their portfolio during a financial crisis. Take a look at the chart on the right, which shows the returns of various asset classes during 2008. On the left, you see that CTAs were up north of 10% when tons of other asset classes collapsed. I've had dozens of conversations with investors about CTA exposure, and invariably they focus on the amount by which the CTAs were up, not the overall percentage or dollar impact on their portfolio. Up 10% in a horrible year is a lot more compelling than, say, my CTA allocation meant that I was down 31%, not 33%. To some, then, the statistical benefit is that it helps to encourage investors to diversify, and the behavioral benefit is valuable during market volatility when investors tend to sell at the wrong time. The academic approach to diversification. Now let's talk about the academic approach. We've all seen charts like this. On the vertical axis, we have expected returns, and on the horizontal axis, we have a measure of risk. In this worldview, very low-risk assets like treasury bills will be on the lower left. Not much expected return, but little volatility as well. Move to the upper right, and you should expect higher returns, but also must be willing to bear higher volatility. The basic idea under modern portfolio theory is that if you combine several of these assets together, the portfolio can produce better risk-adjusted returns. There are a number of big assumptions that underlie this analysis. Some are stated explicitly, others are implicit. For instance, in efficient market theory, the expected return of an asset should rise with risk. If it didn't, investors would sell it and buy something else. Some others. Quote-unquote risk is defined solely as volatility. Expected returns are predictable over long periods of time. Markets are largely efficient, and correlations are predictable and stable. These are very big assumptions, and as you can imagine, there are various real-world problems with this. First, returns and correlations are a lot more unpredictable than theory suggests. We'll show you some examples in a second. Investor pain thresholds and a shorter reassessment period mean that most people won't wait 20 years to see if the assumptions are wrong. Third, models are really sensitive to small changes in assumptions. My favorite recently is the Barclays Agg, which has an artificially low standard deviation, which means its Sharpe ratio is overstated, and hence when you plug it into a model with unsmoothed assets like the S&P 500, the model wants it to be 90% plus of the portfolio. Investment product track records, as opposed to asset classes, typically are too short to support long-term forward assumptions, so it can be a big leap into the dark to estimate how, say, MLPs will do over the next 20 years. To underscore the point, let's look at case studies of commodities and emerging markets. The chart on the left shows the compound annual return of several asset classes against their respective standard deviations over the past decade. As expected, both emerging markets and commodities do have higher standard deviations than the S&P. However, each has underperformed by a huge margin, especially commodities. Now remember, this is over 10 years. That's a long, long time. Interestingly, the underperformance of commodities over a full decade by this degree has a probability of around 1 in 20. So not impossible, but the kind of outcome that most assume wouldn't happen. As we said, we'd round down to zero. The chart on the right shows the rolling correlation of the commodity index to the S&P. 10 years ago, the absence of correlation and high returns made commodities seem like the ultimate diversifier. Plug it into a model in 2006 and you get a big allocation. However, as returns collapsed, correlation spiked above 0.8 for extended periods of time. I have no idea what the probability of a flip in correlation was, but suffice it to say that it's not supposed to happen either. Now, when academic theory collides with the real world, allocators have to make all sorts of assumptions about how dozens of asset classes will perform over incredibly long periods of time. Since the models themselves are sensitive, if one asset has a particularly high expected Sharpe ratio, it's going to soak up a lot of the portfolio. Remember that 90% allocation to the Barclays Agg. To correct for this, allocators have to overrule the model by capping exposure at, say, 15%. The end result is that the output of asset allocation models follows how allocators wanted to invest in the first place. In the comic below, we see that it's a bit like painting the bullseye after shooting the arrows. As an alternative, let's look at how hedge funds view the world. The way they see it, at any given point in time, some assets are cheap on a relative basis and others are expensive. In other words, they don't hug the line. The three big assumptions are asset class returns vary widely over time. A realistic investment horizon is 1 to 3 years, not 10 to 20. And volatility is an incomplete measure of risk. The world simply doesn't function like a bell curve. In practice, unconstrained investors are constantly evaluating the attractiveness of one investment relative to others. It's not just large cap A versus large cap stock B, but large cap stock A versus all other potential investments. Sometimes this occurs from bottoms-up analysis and sometimes from the top down. Risk is viewed on a more holistic basis. Volatility in addition to liquidity, symmetry of upside and downside, and many other considerations. The key is that the parameters that drive many asset allocation models are lifted. If emerging markets are unattractive, you don't have a 1 to 2% tilt, but can exit the space entirely. Which brings us to case study, developed and emerging market equities. Here we look at the divergence in performance between developed and emerging markets. In recent years, hedge funds have been significantly underweight EM due to concerns about commodity prices, debt, structural problems, currency issues, and political instability. In the chart on the right, we see that the S&P 500, a less risky asset in terms of volatility, so one that in theory should generate lower returns over time, outperformed emerging markets by 80% on a cumulative basis over 4 years. That's huge. By contrast, in the pre-crisis years and during the commodity boom, emerging markets outperformed by over 120% over 3 years. If you look at the chart on the left, just over the past year, we have a 15% spread between various equity indices. Yes, the S&P is killing everything else, which makes it frustrating to say the least when it's the go-to benchmark for equity exposure. So hedge funds have had a tough year, and we have some data to explain why in a few slides, but they did avoid some of the worst carnage by staying focused on US assets. Research clearly shows that most hedge fund alpha comes from these kinds of asset allocation decisions over time. For instance, during 2005 to 2007, the golden years of hedge fund alpha, most outperformance was explained by being overweight EM. Yes, you can generate a lot of alpha by getting the asset classes right. So now let's talk about where liquid alternatives fit. Over the past decade, institutional investors concluded that hedge funds shouldn't be classified as a single large bucket, but should be subdivided into 3 depending upon the expected diversification benefit. Equity hedge, which includes equity long, short, and activist strategies, is designed to capture the equity risk premium over time, but with lower risk. This, as you know, is the holy grail of equity-like returns with bond-like risk. The second major category is absolute return, which includes macro and CTAs. The defining feature of this category is low beta to equities, which can be very important in asset allocation models. The third category is alternative credit, which includes relative value and distressed investing. There's a debate over whether we should also include more plain vanilla unconstrained bond funds. For reasons described later, this last category is the most problematic since the underlying markets are often insufficiently liquid. Now let's turn to some case studies on the liquid alternative space itself. We're going to divide it into two sections. The first are one-stop solutions, which include alternative multi-manager funds, multi-asset alternative funds, replication. The second category includes single strategy solutions for equity hedge, CTAs, and alternative credit. Alternative multi-manager funds were supposed to be the second coming of funds of hedge funds. The products were designed to provide one-stop shopping for investors to fill their alternative allocation and essentially incorporate all three of the buckets described before. Take a look at the schematic on the left. Unlike a fund of hedge funds, the managers select established hedge funds to run managed accounts as sub-advisors. The manager also ensures that the overall portfolio is structured consistent with the constraints of 40 Act funds, which are significant, principally limitations on leverage, shorting, illiquid investments, and derivatives. In theory, the funds were supposed to match the performance of funds of hedge funds. Sponsors generally acknowledge that the 40 Act constraints would curtail how the managers could invest. Think of a boxer with his shoes tied. But they asserted that any lost performance would be made up in lower fees. In the end, investors were supposed to end up with the same returns, but with the added and important benefits of liquidity, daily pricing, and regulatory controls. Reality, unfortunately, has been a disappointment. As shown in the chart on the left, the net performance to investors over the past 4 years was only about 2% per annum. This is about half that of hedge funds themselves, which granted didn't exactly knock the lights out. But honestly, if you can do LIBOR plus 420 basis points over time with bond-like volatility, you're actually doing okay. So what happened? We think sponsors seriously underestimated the impact of those mutual fund constraints. When you look at this on a pre-fee basis, 30 to 40% of performance was lost when they tasked hedge fund managers with investing under 40 Act constraints. That's huge. I'd like to note that we highlighted this problem back in 2013. We often relate a conversation with the head of a large hedge fund that had declined to start a mutual fund. When I asked him why, he told me that he estimated the constraints would cost them 600 to 800 basis points over time, about what their investors expect them to earn. As he put it, if you want LIBOR, there are easier ways to get it. This highlights a really important point about the liquid alternative space, which is selection bias. When one of the alternative multi-manager mutual funds allocates to a strategy, we only see the guys who accepted. But what if 10 guys declined since they didn't think they could hit their numbers? The second big issue is that the products are very expensive. The average expense ratio is around 2.6%. While investors used to paying 4 to 5% for hedge funds might consider this to be a bargain, no one else really does. So plan A was to sell these products into the retirement space, but the consensus now is that they're largely priced out of that market, especially given the impending Department of Labor rules. A final issue is that the SEC is closely examining these funds, and we expect they'll find a wide divergence in how different managers treated certain rules, which frankly are actually less the rules per se than a complex matrix of vague, outdated, and sometimes contradictory guidance. It'll be interesting to follow these stories to see whether this contributed to any of the recent closings. Given the disappointing performance of the alternative multi-manager mutual funds, the obvious question is, are there better alternatives for one-stop solutions? In light of this, there are two other approaches that are worth discussing. The first we'll call multi-asset allocation funds. These are essentially macro funds that seek to consistently generate returns of about 500 basis points over LIBOR. The biggest player in the space is Standard Life out of the UK, which now manages a reported $90 billion in assets. It's essentially the largest macro fund in the world that few people have ever heard of. In 2011, John Hancock launched a mutual fund sub-advised by Standard Life, and assets have skyrocketed to about $9 billion today. Putnam Investments and a few other competitors run their own versions. There are two differences between these funds and a brand name macro hedge fund. First, the return expectations are more moderate. and the managers are supposed to closely guard against drawdowns. Second, and really importantly, is that the fee structure is much lower, under 150 basis points on average. If these products have been created by hedge fund managers, I'm sure they'd have incentive and other fees simply because that's how hedge fund managers are used to getting paid. But coming from the traditional side of the fence, the sponsors understand that a 2, 3, 4, 500 basis points expense ratio is a very tough sell for most investors. The second area, and one that's dear to our heart, as you know, consists of replication-based products. What replication does is to synthesize a lot of data about how hedge funds are invested today and invest directly in those markets via liquid, low-cost ETFs or futures. When you think of the chart previously on how hedge funds view the world, you're simply overweight assets on the upper left. Like the multi-asset allocation funds, these strategies go back to before the crisis so we can accurately compare performance. If you're interested in research on this space, please visit our website at www.beachheadcapital.com. But for purposes of this discussion, we'll just use a proxy of some of the larger institutional quality funds in the space. So both strategies are essentially trying to do the same thing: identify attractive investments with relatively low risk investment profiles. Either approach is much simpler and more elegant way of getting to the same answer as the AMFs. In the chart on the left, we see the performance of the multi-asset allocation funds and replication strategies net of fees have in fact been very similar to the Fund of Hedge Funds Index. In fact, if you extend the analysis back through the crisis, you find that both strategies have outperformed hedge funds, but at a much lower cost. A lot of it comes from fee arbitrage, and one of our favorite expressions is fee reduction is the purest form of alpha. The average fees, if you look at the chart on the right, of AMMFs we said are around 2.6 per annum. Replication products are by far the lowest cost at around 1%, and the all-in expense ratios of the multi-asset allocation funds are around 1.5%. So now that we've talked about one-stop solutions, let's turn to the sector strategies. So why equity hedge? Warren Buffett once said that if he didn't have Berkshire Hathaway, he'd invest 90% of his assets in a low-cost S&P 500 index fund and the other 10% in short-term government bonds. Most investors, however, don't have his tolerance for drawdowns or the ability to be greedy when others are fearful. So while equities are the most reliable source of long-term returns above cash, 90% of risk in a typical portfolio generally comes from the equity bucket alone. The goal of equity hedge strategies is to reduce equity risk without sacrificing returns. From a diversification and risk management perspective, this is really where you get the most bang for the buck. The argument that we'll make is that for investors with traditional 60-40 or 70-30 portfolios, this is the best place to start. It's not a coincidence also that this is where family offices first diversified a decade or two ago. The chart below shows the return of an equity hedge fund, equity long-short hedge fund index against the S&P since 2000. Over this period of time, the returns are roughly comparable. However, the hedge strategy had much lower drawdowns and much faster recovery during the crisis in 2008 and in the early 2000s. So what's going on here? When people think of equity hedge, they often talk about alpha generation from long and short stock selection. The empirical evidence, however, is very clear that most alpha generation comes from getting the asset classes right, even within the equity bucket alone. Several slides back, we showed how you can get very wide divergences in returns over 1 to 3 year periods, even among asset classes that are supposed to be similar. Overweight, more attractively priced equity markets, even if this comes from copious amounts of bottoms-up research, and you can generate strong returns with less risk. Other forms of alpha generation, like stock selection, tend to get eaten up by fees. So yes, we're advocates of well-designed strategies to achieve this. In our case, we sub-advise a mutual fund for SEI investments that seeks to match or outperform a specific portfolio of equity long-short hedge funds. You can think of it like an ETF that gives sector exposure without the idiosyncratic risk that comes from picking a single manager. One of the issues of the space, though, is that investors are often like investing with a single manager. There's a better story around it, but this does introduce a different kind of risk. And on that note, A cautionary note about manager risk. Below, we have the poster child for returns chasing and single manager risk in the liquid alternative space. When you look at an institutional hedge fund portfolio, if they want to make an allocation to, say, the equity long short space, you might see 5, 6, 7, 8 managers. The point being that they're looking for exposure to the space, but want to diversify single manager risk. In the liquid alternative space, so far, a lot of people make a call on a given space, but then select a single fund. What you see in the chart below is how pronounced the returns chasing can be. The red line shows the performance of the fund, which did incredibly well during 2011 to 2013, and assets went from less than $1 billion to over $20 billion. The assets are the shaded gray area, and you can see it's scaled on the right axis. The manager made a bad call sometime during 2014, expecting inflation to pick up, and had a big drawdown in 2014, another drawdown in 2015, and assets then flew out the door. So the fund ultimately lost about 90% of its assets and is now around $2 billion today. When you think about investing in a sector, when you make the bet on a sector, it raises a really important point about whether you're looking for sector returns or whether you want single manager risk. And I think that this space is young enough, and as we've seen in the hedge fund space, where even many of the luminaries have been getting killed over the course of the past year, that by and large, most investors are looking for sector exposure, since that tends to be more reliable over time. Now, this, of course, brings us to a second concern: position crowding. It's been hard to pick up a newspaper recently without a news story on Valeant or SunEdison, which have become the poster children for crowded hedge fund trades. The chart on the left shows the one-year performance up until a few weeks ago of 4 long-only strategies that seek to mimic the stocks that are owned by leading hedge funds. Note that over the same period, the S&P is roughly flat, so the underperformance is pretty stunning. Each has a different twist. The Goldman Sachs VIP Index tracks the stocks that are most frequently a top 10 holding among hedge funds. Now, note that the Goldman product currently is just an index, but there's an ETF in registration right now that, when launched, will track it. And by the way, just if you're looking for the best source of information as to what a hedge fund's own today, Goldman leads everyone right now. Alpha and Guru are 2 '40 Act funds that use formulas to buy stock holdings of hedge funds as reported in 13F filings at the end of each quarter. The drawdown in Alpha is exacerbated by some bell and whistle risk control that they have that cause them basically to get stopped out at the wrong times. So you're buying 2 different investment strategies when you look at that fund. The 13D Activist Fund, as its name implies, buys stocks where activists are agitating for control or change. Another way to look at it is to look at the chart on the right, where we use data from Goldman to show what a dollar-neutral portfolio of being long the VIP stocks and short stocks where hedge funds have sizable short positions. The longs have underperformed by about 600 basis points this quarter alone, largely due to a nasty short squeeze in commodity stocks. But this is really what explains a lot of the disappointing performance of some big marquee hedge funds over the past 6 to 8 months. And one thing you should note is that position crowding isn't a new phenomenon. We saw this back in 1997 and 1998 when Tiger Management, which peaked with $20 billion in assets, had its whole portfolio circulated on Wall Street desks when they lost a ton of money on a yen trade, and people were expecting them to have to liquidate across the board. On our end, we've been studying this issue for several years. We first wrote a paper on the GS VIP indices back in 2012. We noted that these portfolios do generate meaningful alpha during stable markets, but they do tend to perform a lot worse in down markets. In 2008, for instance, they underperformed by 800 basis points. The issue that we've been focused on recently is that the population of copycat investors, and by this I mean not just funds like these, which have relatively small pools of capital, but investors in the funds themselves, or frankly anyone with a computer who can now look up 13F filings, would likely exacerbate this phenomenon. And if you read the Pershing Square annual letter from last year, you see that he attributes a lot of he really, frankly, blames other investors that he calls effectively weak-handed for his recent underperformance. I don't agree with that, but in any case, so we're seeing this in spades today, and the last 6 to 8 months has been very difficult as a result. So I think the point that we would make is that this is the kind of a risk that is not necessarily apparent when you're looking at just purely the performance over during a stable market. This is a risk that shows up in bad markets, and in that way, we think of it as something like an illiquidity premium, which is terrific when things are good, but bad when things go south. So now let's turn to the next bucket. CTA and macro, a rare low beta product. So managed futures mutual funds have been around forever, although earlier products tended to have, frankly, staggeringly high fee structures. Bloomberg published an expose several years ago that eviscerated some bank-sponsored funds for running with expense ratios of 600 to 800 basis points. Fortunately, I think those days are behind us. So CTAs and macro funds are often thought of as providing a big diversification benefit due to this low correlation to traditional assets. Now remember, asset allocation models love investments with low correlations to stocks and bonds, and even those with very low expected returns. In theory, you could have something with a 0% expected return, but if it has a screwy relationship to other assets, it could still improve people's Sharpe ratios, although I think for most investors, they look at that and say, why bother? In the chart on the left, we show what a traditional 70-30 portfolio would have looked like over the past 10 years with and without a 10% CTA allocation. Note in this case, we're using a hedge fund CTA index, but but you get the point. So even though CTAs returned only 2% per annum over this period, the Sharpe ratio still goes up. So smoothing out volatility is a huge statistical benefit. However, we think the more powerful benefit is behavioral. And as noted previously, it's very comforting to be able to point to successes when everything else is crumbling. And when an asset is sold as a diversifier, you get an interesting phenomenon in that the decision to invest looks prescient in most circumstances. So take the box on the right. If the S&P is down 20 and CTAs are up 10%, you look like a hero. If, on the other hand, the S&P is up and CTAs are down, well, the argument is that it's protection for a rainy day. If they're both up, it's a windfall. So it's only when they're both down that the investment is viewed as a failure. So part of the popularity, I think, of managed futures funds was this really asymmetrical situation where under most circumstances it looked like a good idea. It was really only after several years of fairly dismal performance and a failure to perform well during periods like 2011 that a lot of investors threw in the towel, although now, as a result of a very good 2014 and a lot of volatility in the markets, investors seem to be coming back. So we think the most problematic area for liquid alts is in the credit space. And arguably, liquid alts and credit is an oxymoron. Some firms have been out there making this case for some time. And we've heard anecdotally from hedge funds that are managing these managed accounts for the alternative multi-manager mutual funds that they really can't do a lot of what they would normally do when investing in their hedge funds. So it all really almost is a different strategy. I think what we know empirically is that a great deal of alpha in credit investing comes from the illiquidity premium. And liquid vehicles, by definition, are going to have limited exposure to it. Now, it's notoriously difficult to price the illiquidity premium. But I think we'd all agree that if you can't take illiquidity risk, you're going to underperform the hedge funds that can. So it's really not just a return smoothing issue. Since most capital wants liquidity, illiquid things tend to be a lot cheaper. In the chart on the left, we show the compound annual returns of two hedge fund indices versus their liquid hedge fund counterparts. And we selected these, which are event-driven and distressed. We selected them because they often have managers who have made a business out of bearing illiquidity risk. For each strategy, what you see is basically that the illiquid hedge funds have outperformed the liquid equivalents by a very, very, very substantial margin over time. It's really hundreds of basis points of lost performance. So, given all the talk of an absence of liquidity in the broader markets, I think you can make the argument that any credit fund that is offering daily liquidity yet invests in non-traditional fixed income is a disaster waiting to happen. Here are three scary data points. As of a week ago, 40% of high yield bonds had not even traded in 2016. So even when you move to the investment grade space, trading is sufficiently infrequent that the standard deviation of the Barclays Agg is understated by half. And there's an ETF, BKLN, that invests in bank loans that takes 2 weeks to settle if everything goes right. So it's worth noting that the SEC is aware of this, is not happy about it, and is likely to tighten, not loosen, liquidity testing for liquid alts funds. I suspect this is going to box a lot of credit hedge fund strategies out of the market, particularly in the collapse of the Whitney Mutual Fund last fall, which really served as a wake-up call. I think the litigation and government investigations that are going to come out of that collapse are going to create a chilling effect. So it may be some time before we see viable liquid alternative strategies in the credit space. So let's leave with a few takeaways. First, diversification means different things for different investors. For some, you'll favor a one-stop solution, for others, a strategy approach. There's also a question about single manager funds versus ETF-esque products or spreading the bets. Second, asset allocation, whether academic or fundamental, is as much art or science. And we think it's important that you understand how investors are coming at this allocation. In other words, what assumptions have they made as they built their own asset allocation models? Because those assumptions are become incredibly important when you decide where these strategies fit and what value they can bring to the table. We do think investors need to be wary of idiosyncratic risks, like the manager who drives the bus off the road, or hidden risks like position crowding and illiquidity mismatches that only become apparent in bad markets. Overall, we think winners will include strategies that are low cost, and the upcoming Department of Labor regulations should underscore this point, have well-defined investment objectives and diversification benefits, and can be explained to end investors. In light of this, we think education and clear management of expectations are going to be critical to counter the returns chasing that has been pervasive through many of these strategies. On the education front, we've been building a library of information and resources for investors. As mentioned previously, on the Beachhead Capital website, we have institutional research on the evolution of the hedge fund industry, unbundling of hedge fund returns, replication, and related topics. On the Dynamic Beta website, we have animated videos that are both educational as well as discuss key trends among hedge fund investors and are really designed to provide support for people making asset allocation and diversification decisions. And we also have a blog that covers recent issues in the markets and how what we call smart money investors are viewing them. So without further ado, why don't we turn to the Q&A session? Okay, I hope you can hear me. I'm just taking a second to switch my gear on this end. We're pulling up a couple of questions now. Let's see what time it is. It's 4:42, so we'll have time for maybe 2 or 3 questions. My team here always gets very nervous when I'm asked questions because I quickly disappear into the weeds. So if you hear the Oscar music playing in the background, it'll be a good sign they're cutting me off. Okay, here's a question. Is comparing hedge funds and liquid alternatives apples to oranges? So this is actually a great question. I think it highlights a couple of important points. So first of all, why do we compare the two? We compare the two for 2 reasons. Liquid alts are marketed as hedge fund equivalents, so I think it's reasonable to test that statement. Secondly, liquid alts often have frustratingly short track records, so you need something comparable to study over a longer period of time in order to assess whether this is something that should or should not be included in your portfolio. The apples to oranges part, though, is that one investment is liquid and the other isn't. And as we know, liquidity is very valuable to most investors. As noted, there's a ton of evidence that illiquid investments outperform. Investors, as a rule, are afraid of illiquidity, so there's a worldwide gap in capital available for less liquid and also for complex investments. So this is why Seth Klarman, Howard Marks, and others sit patiently and wait for the moment when they can be the liquidity provider of last resort. So the problem for an analysis like this, when you're looking at returns of one strategy versus hedge funds, is that the elephant in the room is really what is the value of daily liquidity to the investor? And as a rule, it's going to be a lot more than zero. Unfortunately, people tend to be very vague about precisely how they value liquidity and why. So if I know that I need cash tomorrow, it's obviously super valuable. Interestingly, we found real estate investors who are looking at hedge fund investing to be very clear about this because if a deal pops up tomorrow, they need the cash now. So they ascribe a very, very high premium for anything that ties up their money. And by high, I mean 500 or 600 basis points more than you would expect just from the risk of the asset. A lot of other investors are happy to be illiquid and chase high returns until they're not. And so I think this is a variant of the idea of rounding down to zero. For instance, who thought that the auction rate securities market would freeze up in 2008? So for a lot of investors, liquidity is not something that they price regularly, but that every now and then becomes very, very valuable. So really, to make a clean apples to apples comparison, you should discount the returns from illiquid funds by some amount. And a lot of people would zero in on the number 3%. In other words, in that context, you can make an argument that the alternative multi-manager mutual funds, which returned LIBOR plus 200, actually outperformed funds of hedge funds, which did plus 400 when you factor in the liquidity premium. And so, we've tried to have these conversations in the institutional space, and I think it's correct analytically, but we don't get much pickup. And that's for, I think, a couple different reasons. One of the weird things about hedge funds is that the structure itself, or the vehicle, is often a lot less liquid than the underlying securities. When we're talking about liquid alts, we're worried about the opposite, which is that the structure offers daily liquidity, but the underlying assets don't have it. A hedge fund with 2-year liquidity that's also investing in illiquid assets, that has a symmetrical relationship, and you'd expect the hedge fund to make more money from being in those illiquid assets over time, and that in turn would inure to investors and would offset whatever cost they would ascribe to having 2-year illiquidity. However, a hedge fund with annual liquidity that invests only in liquid stocks is a weird animal, since clients expect it to outperform, even though the fund itself doesn't pick up any illiquidity premium on the underlying investments. So if the investor says, I need a 3% annual premium to tie up my money for a year, then the hedge fund has to generate really a staggering amount of alpha in order for the investor to even break even after fees. So you take the 2 and 20 of fees, you add in another 3%, and maybe it's 600 to 700 basis points of alpha, and that's generally going to be a very, very high and often unattainable hurdle. Remember, that's just a break even. So I guess a final point on this, and as you can tell, I could probably go on for a long time about this, but I think a final point on this is that some investors or some allocators actually prefer illiquid investments. This is often not for economic reasons, but rather because illiquid investments don't get marked to market. When we first started talking teams at institutions that oversee hedge funds, we were surprised to find that many were uncomfortable with the idea of daily liquidity. And this was odd to us because when you look at the vast majority of their portfolios, whether it was stocks and bonds or other things, everything else has daily liquidity. But these guys tended to be in their own category within the asset allocation decision-making process, where everything that they invested in were illiquid partnerships. And what we realized over time was that it potentially pushed responsibility onto their plate, whereas in illiquid vehicles, it's always the fault of the manager if they didn't see what was going on in the markets. And I think one thing to remember is that many allocators blamed funds of funds and hedge funds themselves for all the gating and suspension that occurred in 2008, 2009. And implicit here is the idea that if the allocators had liquidity, they would have done a better job of reducing risk at the right time and keeping clients happy. I don't think that's an accurate recollection of what was actually going on at the time. But the point is that once you have liquidity, after you've been telling people that liquidity is very valuable, now the question becomes, what do you do with it? Personally, I think these investments should be viewed like any other allocation. They should be long-term investments. Um, but um, it does raise the question for the allocation team: is that can you now be held responsible for cutting risk at the wrong time or not cutting risk at the right time, i.e., when markets are about to collapse? And so I think rationally, most allocators would agree that liquidity is valuable, but I think it's important to recognize that there is an agency issue where what's good for the client may not be good for the allocator's job security, and it's ultimately the responsibility of the client to police those kinds of conflicts. Okay, I have another question here. What about alternative risk premia? Whoever asked this question, you're correct that I glossed over it a little bit. As you probably know, though, it is one of my favorite topics. I didn't discuss it here directly because the topic is quite complicated, and I view it more as today really as an institutional only product or in variants that I'll describe. For those on the call who are not really familiar with the alternative risk premia space, let me give you 2 minutes of background. So there are two camps in the replication world. Our camp, in our view, is that asset allocation is the big driver of alpha generation, that this is really where you get the most bang for the buck. The other party, the other camp, looks at individual trading strategies that hedge funds have done for years and wants to program a computer to do a simple, cheap version of it and get most of the returns of what hedge funds do. If you were looking for the standard bearer of that approach, look no farther than AQR, and Cliff Asness, one of the founders, was quoted in a good article on the topic in the Wall Street Journal this morning. What we all agree is that most of what hedge funds do is not magic, and that if you understand it well enough, you can offer versions of it to clients with low fees, liquidity, etc. The term alternative risk premia, though, is, I think, a little bit of a misnomer. So the theory is that certain trading strategies that have generated excess returns over long periods of time can be easily copied and replicated, and if we can identify that there's a risk premium associated with it, then all we have to do is set up a model to do it. So really, really great in theory, but I think what I'll explain becomes a lot harder in practice. Merger arbitrage is often used as the simplest example. There's some evidence that after a deal's been announced, most stockholders will sell that stock a little bit too cheaply. And the argument is that for behavioral reasons, after they've made a profit on the stock with a big 30% pop when the deal gets announced, you now have a behavioral loss aversion issue. They don't want to lose it. They're not really in the business of deciding the probability that the deal goes through or doesn't go through. And so if they have to sell it for $1 less than they otherwise would have, they're fine with that. They'll take their money and go away. And so for years, the way you've invested in that was to identify merger arbitrage specialists. I'm going all the way back to Robert Rubin and the risk arb team at Goldman Sachs, later Eric Mindich, and you'd have teams of people who would go to stocks, hedge some risk, and sweep up these nickels over time. Some people have called it like an insurance business. Actually, Eric Mindich used that term. What the risk premia guys argue is that here is a legitimate, sustainable, long-term premium source of excess return that is built on behavioral biases, the fact that a lot of investors can't short things, the fact that analyzing deals is a little more complicated than other things. And so what they say is you can program a computer to buy every target, do some sort of hedging, whether selling every acquirer or not, and you end up in roughly the same place. And the argument is like, it's very similar to the argument that we make, is that rather than invest in a manager at 2 and 20, if you can get the majority of what they do at much lower cost and with daily liquidity, then you're much better off over time. So the whole space took off like a shot a few years ago, predominantly in the institutional space. And a lot of the strategies, especially when you jam them together in a portfolio, have the terrific characteristic of having low correlations to equities. And that is a very, very rare asset indeed. I should say low correlations to equities and other traditional assets. So initially, when the banks created the products, they primarily were using back-tested data, and just a function of when you get people building historical models, there just is a tendency to turn the dials a little bit to the left, a little bit to the right until the numbers look a little bit better. So a lot of the products had unrealistically high Sharpe ratios. Some of them were really high. On the Beachhead website, there's a note called The Danger of Indices, where we talk about one fund that had a back-tested track record over 2003 to 2013 that essentially would have made it one of the top performing hedge funds in the world, and then subsequently, as soon as it went live, did not do well. It's a real problem. So overall, though, I'd say the area is going through growing pains in a couple of different respects. First, it's very difficult to get good industry-wide data to be able to analyze how these strategies have done once they've gone live versus the backtest. When we've been able to see aggregate data, instead of the hoped for 1 to 1.2 or even higher Sharpe ratio, which would be 3 or 4 times what you'd expect in traditional assets over time, performance has been much, much lower. And there's also been a huge dispersion of returns. So you pick the wrong instruments and you end up with a really bad outlier performance. With time, I think potential investors have become a lot more sophisticated about pulling apart back-tested numbers. The banks now generally delineate back-tested versus live. And one thing that's a little unusual about this space is that indices, for people who are used to looking at funds, indices are odd things. They're not investment funds where you would have all sorts of copious disclosure requirements. Since they're labeled as indices, you can pretty much stick back-tested numbers on a billboard without any real disclosure. I think people now realize that the moniker risk premium, as I mentioned, is a bit inaccurate because when we think of something that's a risk premium, like the equity risk premium, we're looking for something that's clearly identifiable. So if you got 10 of us into a room, we'd all come to a similar definition of what it is and how to calculate it. These trading strategies are really complicated. So even when you're talking about just merger arbitrage, you have to make 30 or 40 different assumptions that go into what universe of stocks do you include? How do I define acquisition? Somebody's buying a third of a company, do I treat it or not? Do I equally weight positions when I invest in them? When do I rebalance? Am I shorting the market for in cash deals? It goes on and on and on. We've written a bit on the Beachhead Capital website, so if you're interested, and obviously we're always delighted to have dive into the weeds conversations with anybody, but you can see some of the ways that we've addressed those issues there. And the answer is that those 10 people in the room, each one comes up with a very, very, very different version of what the merger arbitrage risk premium looks like. So as an investor, you pick me versus somebody else, and you get wildly different results. And I think that undermines the idea that you can really call these things risk premia. And risk premia, part of it is a marketing term because it makes it easier for the allocator to invest in a risk premium than it is to invest with a manager, because the risk premium is something that's supposed to be supported by decades of academic research. It's always supposed to be there. It's a stable long-term allocation. I think when you have all of these different parameters and nobody can agree on exactly what it looks like, it falls outside of that definition. So what it really means is that to us, these are much more like actively managed investment products. In the same way that the multi-alternative or multi-asset alternative or allocation funds are lower cost versions of global macro funds with a slightly different risk constraint, that's what these are, lower cost versions of very specific investment strategies. And somebody still has to decide which strategies you want, when you want them, which
designer of the model and strategy you think is the best and why you think they're the best. So it's a much more active decision than the name risk premia implies. That said, I think these products have a very, very bright future. They're part of a bigger trend of unbundling hedge fund returns. There have been some good articles on that in the Wall Street Journal and Financial Times recently. And frankly, the more we have good, well-managed, low-cost alternatives to investing in hedge funds with similar risk profiles, the better off all investors will be. People can have a broader range of options from and can start to make more credible or rigorous assessments as to when you do want to pay 2 and 20 and when you don't. So I'm getting waved. It looks like we're pretty much out of time. Again, I'd like to thank everyone very, very, very much for taking the time to join us today. It looks like we had a very, very good turnout. I'm really appreciative of people taking time out of their busy days. If you have any questions, feedback, or just want to compare notes or share stories, please don't hesitate to reach out directly. We have, I hope, recorded this webinar, and we'll post it on our website and perhaps on YouTube. We have a YouTube channel, believe it or not. So please feel free to pass the link on to others if you think it was helpful. And without further ado, I would say have a terrific day and enjoy the spring weather.